All right, welcome to the Explainer. Today we're going to tackle a really important and often confusing part of your compensation, non-qualified stock options, or NSOs.
So let's just dive right in. The way you handle these things can mean a huge difference for your bottom line. We're going to break down how you can navigate the choices ahead of you to really maximize that potential windfall, and, just as important, how to avoid some pretty nasty hidden traps.
Okay, first things first. We got to get on the same page about what NSOs actually are and how they work. The basic idea seems simple enough, but believe me, the details are where things can get complicated and fast.
So, an NSO isn't actually a share of stock. The key word here is option. It's the right to buy a share at a set price, your strike price, which is hopefully way lower than what it'll be worth in the future. Think of it like a special coupon to buy your company's stock at a deep discount.
Every option has a life cycle, kind of like a journey. It all starts on the grant date. That's when the company gives them to you. Then you've got the vesting period, which is basically a waiting game. Once they're vested, you can exercise them, and you have until the expiration date, usually about 10 years down the road, to make your move. Okay, now we're getting to the single most important moment in this whole life cycle. This is the part that, honestly, catches almost everyone off guard. It's the moment your options transform from a nice idea on paper to a very real tax event.
And this is it. This is the big one. The second you decide to exercise, bam, you trigger a tax bill. And no, you haven't sold a thing, you haven't seen a single dime of cash, but as far as the IRS is concerned, you just got paid.
So what's happening here is the IRS looks at the difference between the stock's current value and your low strike price, and they say, hey, that spread, that's income. They call it the bargain element, but a lot of people call it a phantom gain for a good reason. It's income you're getting taxed on before you've actually put any cash in your pocket.
Okay, let's make this real. Say you've got 15,000 options, and your strike price is a sweet $3 a share. The company does great, and the official value, the fair market value, is now $35. The moment you exercise, on paper, you've just created a taxable gain of $480,000.
So what does that paper gain mean in the real world? It means you owe taxes, a lot of taxes. If we assume a combined 45% tax rate, that's an immediate out-of-pocket tax bill of $216,000. I mean, just let that sink in. You have to write a check to the government for over $200,000, and you haven't even sold any stock yet.
Okay, so seeing a number like that is pretty terrifying, right? Which brings us to our very first strategy, what we call the early exercise play. This is for the folks who want to be proactive, who are maybe a little more risk-on, and who want to play the long game with the tax man.
Now you're probably thinking, why in the world would I want to pay taxes any earlier than I have to? Well, it's all about starting a one-year clock ticking. The whole goal is to exercise, pay the tax on that initial gain, and then hold the actual shares for more than a year. If you do that, any future growth is taxed at the much friendlier long-term capital gains rate.
And we are not talking about small potatoes here. The savings can be absolutely massive. Just look at this. By getting into that long-term capital gains bracket, your final after-tax take-home profit could be up to 27% higher. That is a huge incentive to think about doing this early.
But, and this is a big but, that early exercise strategy isn't free. It takes cash up front, and you're making a bet that the company's stock is going to keep climbing. So what if you're more of a risk-off person? Well, that leads us to a completely different, much safer strategy.
This is what most people think of, and it's called a cashless exercise. The idea is simple. You just wait. You wait for a big liquidity event, like the company going public or getting acquired. Then, in one single, seamless transaction, you exercise your options and immediately sell just enough shares to cover the purchase cost and the big tax bill. You don't need a penny of your own cash. Sounds perfect, right? No risk, no cash up front. But here's the catch, and it's a big one. By taking this safe route, you completely lose out on those sweet, low, long-term capital gains tax rates. Every single dollar of your profit gets taxed as ordinary income, the highest rate there is. You're basically trading a bigger payout for zero risk. So, the choice seems pretty black and white, doesn't it? You either take a risk early for a potentially bigger payout, or you play it safe and take home less. But what if I told you that's not the whole story? What if the conventional wisdom is, well, maybe missing something? Now check this out. This is a pretty sophisticated argument that kind of turns everything on its head.
It basically says if you think the stock is really going to pop, it might actually make more sense to wait and just pay the higher tax rate. Now, how on earth could that be possible? Paying more in taxes to make more money? It sounds crazy.
The secret sauce here is leverage. Just look at the numbers. In the exercise early scenario, after you pay the costs and the taxes, you're left holding just over 4,000 shares. So only those shares benefit from any future growth. But if you wait, you're still holding on to your options for all 10,000 shares. When the stock price shoots up, that growth is applied to a much larger base. And in this example, it's not even close. Waiting leads to a 36% larger after-tax payout, even with the higher tax rate. Mind-blowing, right?
So that little twist just shows there's no magic bullet here. There's no one-size-fits-all correct answer. The best strategy isn't just about tax rates, it's about leverage, it's about risk, and it's deeply personal. So let's break down the factors you really need to consider.
At the end of the day, you really have to look in the mirror and ask yourself some hard questions. Do you actually have the cash sitting around to exercise early and pay that massive tax bill? How much risk are you really truly willing to take? How strongly do you believe in this company's future? Your answers are what will guide you to the right strategy for you.
Look, if there's one single thing you take away from all this, let it be this: you have to be proactive. You can't just wait until an IPO is announced to start thinking about this stuff. By then, your best and most strategic options might be off the table. Seriously, talk to a financial advisor, talk to a tax professional. They can help you run the numbers for your specific situation.
So now you know the strategies. What's your move going to be? Do you exercise early to lock in those tax savings, or do you wait it out to maximize your leverage on a bigger gain? There's no easy answer. But now you understand the trade-offs, and that is the first, most crucial step in turning your NSOs from something that feels complicated and stressful into a powerful tool for building some serious wealth.